Hey everybody, Kevin Gatzliff here. I'm Associate Professor of Finance and Insurance in the Department of Finance and Insurance at Ball State University. First time I'm going to be doing this type of video, so I just wanted to let you know a little bit about what my expectations were and what I'm hoping to get out of going through this with you. Number one, I'm hoping you've already gone through this material because I'm just going to hit the highlights, and really what I want to focus on are the things that are going to be coming up on that end of the chapter exam that you have to take. So by going through this, I hope to be able to point those out, and then that means if you take some time to watch this, that should make it easier for you to do well in the end, and that's what I'm hoping for. So chapter 3, earnings and income, the building blocks of your financial journey. All right, fancy title, appreciate that from the book here. We'll talk a little bit about the outline here, the learning objectives. You can read through these at your leisure if you need to, but it's a pretty good outline of what they expect you to know to be able to do well on that end of the chapter exam that you have to take. So they kind of start off with something that's a little bit understated for how valuable it is. The goal in creating wealth is to be able to spend less than you make. That really is the secret of being wealthy. Every wealthy person got there through this idea by creating what we call surplus that they then invest. But the key idea is this: you have to spend less than you make. The way the book says it is that you produce more than you spend. That's the same thing. I think the easiest way to get the idea across is spend less than you make. And the reason I'm harping on this so much is the average American spends 104% of what they make. So the average American spends more than what they make. And when you do that, you're borrowing from the future, and you don't have anything to invest. You've got nothing to create wealth. And the end result is a situation where you don't have a comfortable retirement to speak of. You'll be working until you die if you continue to always spend what you make. And the typical American spends a little more than what they make. So it's really, really a crucial idea to talk about that wealth creation comes from spending less than you make, or the way the book says it, producing more than you spend. So that's the idea. We have to spend less than what we make, and then we invest the balance, and over time that grows, and that's what creates a comfortable retirement. That's how you build wealth. So we got a pretty little diagram here to show that how that works. If you have income greater than your expenses, then you got something left over. We call that the surplus. You're investing that. You're earning interest. And then on top of that, you're compounding the interest on top of itself, and that's where wealth is actually created. That's something we'll get into in a future topic in the book. But that's really the key. That's where it starts. You have to spend less than you make, and most Americans struggle with that. So that's why this book is so interested in making sure that people follow that idea. A couple things that you'll find out is that the key to being able to get compounded growth that's meaningful is to save early and to continue to build on that. And so here's a little diagram to show what that looks like. Somebody who starts saving at age 25, if you read down here, you can see the notes here. If you save $5,000 at the start of every year from 25 to 65 and you get 8%, if you could save $5,000 a year, if you started at age 25, you'd end up with just short of $1.4 million. If you wait just 5 years and you do the same thing, $5,000 a year at 8%, by waiting 5 years, you're costing yourself a little bit more than 25% of the ultimate ending balance. Instead of having 1.4 million, you're going to have under 1 million. And that's the impact in waiting 5 years to save for retirement. So it's critical to adopt these habits early. And my advice would be, with your very first full-time paycheck that you get, you need to be setting aside a considerable amount for savings. 15% is the number I use. We'll see that the book has some slightly different ideas here, but more is better. And again, the goal is to get compounded interest. That requires time. And so the earlier you start doing that, the more effective it is on the back end. So the converse of that is if you don't generate a surplus, that sounds like you're spending everything that you make. And if you spend more than you make, you end up with a deficit. And somehow you've got to finance that. And when you do that, you're borrowing from the future. And in addition to that, now instead of earning interest, you're paying interest. And you are rapidly reducing your ability to provide a comfortable retirement for yourself when you do that. That's why they talk about this so early on in the chapter here. That's what we're trying to prevent. So we got the diagram showing the opposite here, and financial misery. Yep, that's deficits. That's what that'll do for you. So to be comfortable, a surplus and creating that surplus is critical, and you get there by spending less than you make. So one way to measure that is to just look at how much do you save every year and compare that to how much you earn every year. And there's nothing special about it. They're going to call that the savings ratio. This is something, by the way, that does show up on this end of the chapter exam. And they expect you to take this out to 2 decimals. There's nothing hard about it. You're just dividing. How much did you save and how much was your income? And you divide that. And they suggest that for young people, your target should be 12%. And then it should gradually increase over time to 15%. And then over 40, they want you to try to be focusing on saving 20% of your income. That's aggressive. Most people can't do that. And that's why it's looking like most Americans are not preparing for a comfortable retirement. This prescription will deliver that for you. And so it's worth thinking about your very first job that you get. My advice would have been focus on 15%. The book says 12% is your magic number for a young person. And we're just taking how much did you save and dividing it by how much you earned in the year. So we have a couple critical strategies to help us save that 12%. And something that doesn't get enough attention is this idea of payroll deduction. And the thought is, well, hey, if it's taken straight out of your paycheck, and if we put that straight into a retirement plan or some other type of savings account, if you never see it, you'll never miss it. It's so much harder to start out and say, well, I'm going to save $300 a month. If you actually have to write that check every month, my guess is if your plan is to do this for a year, there will be at least 1 month where you miss that target. Things happen. You have an unexpected appliance repair, your car breaks down, and it's really easy to say, well, I'll get back on track next month. The problem is by just missing one of those payments every year, you're going to put that goal of savings in jeopardy. And so that's the problem that we have. We don't want to put that at risk, and the best way to prevent that is to have the money come straight out of your account. So first job, my advice to you is make sure you're saving at least 15% of your income and take it straight from the paycheck. This is a really good piece of advice that comes from the book in terms of saving strategy, because if you don't take it straight out of the paycheck, then the odds are that you're going to miss contributions, and that's ultimately going to affect how much money you end up with come retirement time, which dramatically impacts whether or not that retirement is comfortable. So that's what we want. Another strategy that's really smart to be considering is every raise that you get. So we're expecting that most of the time people get raises every year. And if we can establish your standard of living at that first paycheck minus 15% savings for retirement, that's your standard of living. And so I say it's really important to do that with your first paycheck, because if you don't, you'll establish your standard of living at the full amount of your paycheck. You'll be spending everything you make. And what you find out in the future is it's really hard for people to cut back their standard of living, even by a small amount, to try to increase their retirement savings. That's a problem everybody has. It's amazing when you think about people with 6-figure salaries. You say, well, sure, it should be easy for them to cut back and save a little bit more. Even they can't do it. Folks who have high salaries just have nicer houses, nicer cars, nicer vacations, nicer things. They struggle to save just as much as everybody else does. So it's not even a strategy to say, well, I'll earn more money. That only works if you're committed to saving. And so I think the smartest thing you can do when you get that first full-time job, make a specific decision to save at least 15% of that income and put it aside. And then with the raises, when we get to the second strategy here, put at least half of your raise into saving. Fine, go ahead, spend the other half, live a little, treat yourself to a vacation. There's nothing wrong with that. But if you make a commitment to saving part of your raise, then over time you're increasing the amount that you save. And you can see how that strategy folds together with the idea that you start out at a lower percentage, and then as you increase your age, you're increasing the percentage that you save over time. So that total savings percentage is going up. And so here you see that strategy laid out here. If you were starting out with a relatively small savings rate, in year one, if you were only saving 3%, if you're getting 5% raises every year and saving half of them, then you can see the percent that you're saving growing over time, and within a period of 6 years, you'd be up to that magic 15% target. So you can get there just by committing to saving half of your raises, assuming that 5% raise is something you can count on, which perhaps is a little bit optimistic. To the extent that you can save more, if you're starting out, here, their example, you're starting out at a 3% savings rate. I would tell you that very first job, try to get to 15%. And once you start doing that, then after year 6, you'd be closer to 20%. And again, we're just trying to create a comfortable retirement for you. The alternative is work until you die. If you choose that, that's fine. But I'd like you to have that choice. And the only way you're going to have that choice is if you start saving at an early age with that first job. And I know it sounds strange. You say, why do I have to worry in my 20s about creating a retirement that isn't going to happen until I'm in my 60s? But the reality is the only way to get significant compound interest growth is to have a long time period for that growth to occur. And that means you have to start saving early. We'll have some examples on that. You probably did work some examples in time value of money demonstrating. Okay, so here we got a separate sample problem when we can look at calculating a surplus. All we're doing is we're saying how much do you make, how much do you spend, what's the difference? If you spend more than you make, you don't have a surplus, you have a deficit. So here, what have we got? Well, all right, he makes $3,300 a month. All these numbers have to be given to you. There's nothing to calculate. So we're just adding up how much he spends and comparing it to how much he makes. All right, he pays $800 in taxes and $700 in rent. That's $1,500. He pays $450 for food. So $1,500 plus $450, that's $1,950. Another $225 on a car payment. All right, so that's $2,175. $150 in gas and maintenance. That's $2,325. And then $700 in entertainment every month. So that puts us at just a little over $3,000 that he's spending. I've got that he's spending $3,025 in my head. And if he's making $3,300 and spending $3,025, well, the difference is $275, and that's the surplus that he's got. So the right answer to this question here is C, $275 in the surplus. If you want to write that down and double check it and add it all up, that's okay. There is a problem like this on the end of the chapter exam. So it'll have different numbers, and you'll have to know how to do this, but it's not difficult. You're just adding up the expenses, comparing it to what they make. If he makes more than he spends, he's got a surplus. If he spends more than he makes, he's got a deficit. And the numbers tell the story as to what's going on there. Okay, so then the book distinguishes between income and earnings. So it's both the earnings are a subset of income, and it's a little confusing because earnings is going to be the primary form of income for most people. Sure, you can get income from other sources. Maybe you have a trust that pays you money that grandparents set up for you. Maybe your parents gave you a gift. Well, yeah, that's income that isn't earnings because it doesn't come from compensation from an employer. But for most people, the majority of their income is going to come from earnings. But it's true that there could be other things that come in. Maybe you qualify for certain government programs that provide you help. Yeah, that could be a form of income. Maybe you've got some investments out there. Well, investments are going to sometimes provide interest, and sometimes they'll provide dividends. Those are forms of income, and because they don't come from an employer, they aren't considered earnings. Maybe you're a retiree and you're getting Social Security payments. That's your income. That's fine. That's not earnings because it doesn't come directly from an employer. When we focus specifically on earnings then, we've got 4 different types that can show up. And some of this you probably already know. The difference between a wage and a salary. A wage is usually hourly, and a salary is usually provided over a fixed period of time. And then there's other types of earnings payments that can happen. Maybe you're in a sales position and you're earning commissions. So the more you sell, the more you earn, and that's just an additional payment based on sales. That's a commission. Maybe at the end of the year, your employer gives you a bonus. That can happen. That's a source of earnings as well. All of these are coming from the employer, and that's what makes them earnings. This next slide shows us a little bit on average rates of pay for certain occupations. And by itself, I don't know that it really says a whole lot. And these are averages. They're coming from the U.S. Bureau of Labor Statistics. Some of the categories are kind of hard to understand. Some of them aren't. Some of them make sense. A flight attendant, I think, okay, we all know what that is. A bus driver, we all know what that is. What's a business manager? That's maybe a little bit more nebulous, a little bit harder to define what's going on. So they just pulled some average income earning estimations from the U.S. Bureau of Labor Statistics, and they have a whole lot more data. You could go out and look there if you wanted to. One note that they make is if you want to earn more, a lot of times it means you have to be managing other people. And so the way to get to management is, one, by having more experience so that you can be promoted, and then sometimes by having additional education. And that additional education means that you might have to invest in yourself and to increase what's called your human capital. More information on that in a little bit. When we talk specifically about overtime, certain workers are protected by the Fair Labor Standards Act. And what that means is if you fall into that classification, your employer must pay you at least 1.5 times your hourly rate if they expect you to work more than 40 hours in a week. And some of you already knew this. If you work more than 40 hours in a week, for each hour that you have to do that, then for those hours you can earn an additional 50% because they have to pay you time and a half. So if you made $9 an hour, then and on any of your overtime hours more than 40 hours a week, if you made $9, they would have to pay you time and a half, which would be $13.50, right? $4.50 being half, $4.50 plus 9, $13.50. That's where I'm getting that. So that would be your overtime rate, and we apply that to any hours that you work in excess of 40. So you might think, all right, if I want to increase my income, one way to do that is to maximize the number of overtime hours that I work. And that's a good personal strategy. But the book says, well, you can't always plan on that because businesses know that overtime hours are expensive. So they're trying to limit that. And so that's the problem that you run into there. If you're relying on overtime and then all of a sudden new boss comes in and says, hey, we're going to reduce overtime because that's expensive for the business, that'll have personal consequences. So the book doesn't like overtime pay as a strategy for boosting income on a permanent basis, although it certainly will increase earnings to the extent that you can rely on that. So the next slide actually puts a problem in here for overtime rates, and that is something that you'll be expected to do at the end of the chapter exam. So, all right, it's just a math problem. We're saying you get time and a half for anything over 40 hours per week. You get your regular salary for those. You get your regular hourly rate for those first 40 hours. So we're saying, all right, she makes $8.50 an hour, and she gets time and a half for over 40, and she works 50 hours this week. How much is she going to make? Okay, well, I'm going to use Excel just to solve this problem, just because I don't have a way to write it out and show you what that looks like. So if she's making $8.50 an hour, you can put that here, and she works 50 hours, so 40 hours, she'll get paid $8.50, right? So I can just multiply that across and look at what the 40-hour payment would be, right? So that's the part for working those 40 hours, and then she works 50 hours, so that's 10 at overtime. What's her overtime rate? Well, it's time and a half, right? So it's 8.5 times 1.5. Right, and that should be $12.75. Well, okay, for those 10 overtime hours, she earned $12.75. For 10 hours, I can see that's going to be $127.50, but I'll go ahead and do it the same way. Multiply across and show what that's going to be. So the regular portion is $340. Her overtime portion is $127.50, and that means her total is just, if I add those two up, that's what the problem's asking for. $467.50 should be the right answer. Let's see if that is one of our answers. $467.50 is on there, so I feel pretty confident about that. If you work for $8.50 an hour and you work 50 hours in the week, that's what your gross payment would be. Of course, that's not what you get in your paycheck, right? There'll be deductions for taxes. There'll be deductions for Social Security and Medicare, and there may be some other deductions that your employer takes from you. Maybe you have to pay for uniforms, for example. There might be other deductions there. But the gross rate of pay should be $467.50. So if you own a business, if that's where your income comes from, then we consider you self-employed. And we got a couple other tests to really indicate that you're self-employed. It means you choose your hours of work, you set the charges for your products and services, and then on top of that, you're paying your own taxes. So that's the idea of being self-employed. Maybe you own your own business, you employ yourself. You're both the employer and the employee. Some of the advantages of owning a business, you do have the freedom to set your own work hours. That's true to an extent. I think something that's in here that isn't talked about is that typically folks who own their own businesses work pretty hard. Owning your own business is not a 40-hour-a-week job. You're working all the time and you're always thinking about your business, and customers are contacting you sometimes out of business hours, and you want to take care of them because you need your customers to be happy so that you can eat. Your income depends on the happiness of your customers when you own your own business. So sure, you got the freedom to set your own work hours, and if you're successful, you probably will do financially. But again, you're putting in a lot more work, so you probably deserve to expect to do better financially, because if you couldn't do better financially, then why would you work all the extra hours that come along with owning your own business? And that's something to think about. It's true that there are tax advantages from owning your own business, the way you can classify income, the way you can time expenses to manage your tax liabilities. That's probably beyond the scope of a personal finance course. But it is true, if you own a business, that's an extremely advantageous thing to have in terms of managing taxes. And yes, if you're successful and you develop a good business, at some point somebody will want to buy that, and that could result in profits for you. And a lot of times the folks who own their own businesses, that is their retirement. They build this business over time, they work there, and then when they're ready to retire, they sell. And if it's successful, there'll be somebody who wants to buy. Those are some of the advantages of being self-employed. There's risks that come along with that too, and the biggest risk is most small businesses don't survive in their current form for the long term. If you look at this slide here, it's talking about 50% of small business startups last 5 years, and only a third are still around after 10 years. That's a particular fact you're going to want to remember for that end of the chapter quiz here, that a third of small businesses are around after 10 years in their original form. So one of the problems that you have here is it makes it look like most small businesses fail. That may or may not be true. We're talking about staying in their original form. Some of those small businesses get sold, and that's a success. But here it's almost counted as a failure because they wouldn't be around. So a third of small businesses are around after 10 years. And that's something that the book highlights. That's as one of the risks of owning your own business. So when you form your own business, you have a couple of choices as to how you want to organize. The easiest way, and if you do nothing, this is what your organizational form is a sole proprietorship. And what that means is it's just you. You as the person and you as the business are inseparable. You're the same. And so the advantage is it's easy to start up. You don't need to file a whole lot of forms or paperwork or anything like that. If you do have business losses, that'll lower your tax liability. On Schedule C is where you're going to file your business self-employment income gets filed on Schedule C, and that's part of your personal tax return. So business losses would potentially offset your other income that you have, and that can be a tax advantage. You've got to be a little careful there when you're losing money as a business. If that happens too often, the IRS will classify your business as a hobby, and then that means you can't write off the expenses anymore. So you have to eventually make profit for the IRS to allow you to take earlier business losses. The biggest disadvantage of having a sole proprietorship, and this is one of the key things that's going to show up on that exam at the end of the chapter, you have unlimited liability. In other words, if somebody claims that your business has wronged them or has damaged them, has damaged their property, has caused them bodily injury, they can personally try to recover from you. And that's the biggest disadvantage of having a sole proprietorship. And that's why if you talk to pretty much anybody who advises small businesses, they will tell you you need to set up a different legal structure to protect yourself. If you continue to operate as a sole proprietorship, the possibility from the possibility that you could be damaged from the liability that you have to other people that you've injured or damaged their property is personally something that you have to concern yourself with. You could be personally wiped out by a liability loss, and that's a big risk. So one way to form, if you have multiple people who are involved in ownership, one way to form is to use a general partnership. So what usually happens there is the general partners, there will be a number of them, so it might only be two, but more commonly more than that, they will use their own capital to fund the business, and then they'll be making ownership decisions. And so one of the things that you hear is if you're thinking about a partnership, it might be wise to have an odd number of people who make decisions. So that you don't end up with a deadlock, right? If you just have two partners and they disagree on what to do, well, you can't really move forward. So if you have a general partnership forming a business, they're usually providing their own capital. The tax implications, that all rolls through to you from the partnership on a K-1 form is what they call it when you're filing your taxes. If you're part of a partnership, you'll have a K-1 form given to you. So like when you have when you're just working for an employer, they'll issue you a W-2 form, right? And that's just the name of the form that they give to you. That's what you use in your taxes. If you're also part of a partnership, you will get a K-1 form. That's where we report partnership income. And we just calculate it based on if there's 4 partners, you'll have to pay taxes on 25% of the income. And that's what would show up on your K-1. Each partner, though, if you're a general partner, you have unlimited liability. So same problem with the sole proprietorship. It's just that the advantage here is when you got multiple people, it might make sense to structure as a partnership. It's possible to structure as a limited partnership. So you do need, eventually have to have somebody serving as a general partner, and that person will have unlimited personal liability. There's no way around that. But the rest of the people who are involved can be limited partners. And that means that the limited part means their liability is limited. In other words, if somebody were to sue the partnership, you wouldn't personally be held liable. Only the partnership assets would be attached for a limited partner. General partner doesn't have that protection. Then all of a sudden we have limited liability partnerships, and now we've insulated all of the owners from legal liability. So if you've got a limited liability partnership, that means nobody is going to be personally liable for business debts. And it could be taxes owed by the business. That could be a debt. It could be a situation where somebody does sue the business and win a liability judgment. Well, the business assets can be attached to satisfy the judgments. Your personal assets cannot. And that's the advantage of having limited liability. If you want to go a step further, we can have limited liability companies. An LLC is a common way to form. And the idea here is now you've got a better limited liability. So similar to partnership, we've got multiple owners, but a limited liability company is going to be able to shield the individuals from any liability that they might have for business operations. It costs more to set these up, but the protection might be worth it, and that's why some of the financial planners that advise businesses will say that you should consider forming as a limited liability company. If you want to go all out, the way to do that is to form a corporation. And when you do that, then you will not be personally responsible for any business liabilities if you form a corporation. So once you form a corporation, that's a legal structure that's completely separate from the owner. Corporations are expensive to form and maintain. There's forms that you have to file every year with the Secretary of State to be licensed to do business. You have to have an annual meeting. You have to have a board of directors. You have to file addresses for everybody and provide public information so that people know where the corporation can be contacted. It's a lot of work to set this up. Honestly, if you're going to set up a corporation, you're probably going to get some help from somebody to do that. Most lawyers would be able to do this or direct you to somebody who could. And I wouldn't call it terribly expensive to create a corporation, but to maintain a corporation can be expensive. And you can have many, many owners once you form a corporation. You'll have stockholders. In a small corporation, you might have a single stockholder or maybe a half a dozen stockholders. In a major corporation, you can have thousands, tens of thousands, hundreds of thousands, millions of stockholders. And the biggest companies that we have in the U.S. are organized as corporations, and they are run that way. Stockholders vote on the board of directors, who then appoints the management. Those are at the largest end of things. Here, we're talking about small businesses, for the most part, being self-employed. You can form a corporation that only has one stockholder, and that will protect you. That will limit your liability. That's a good thing, but it will entail some expenses in setting up and maintaining this corporation. Ooh, here's a good one. Okay, so we've got two people going into business together. What form of partnership arrangement will limit their individual and joint liability? Well, we've got limited liability partnership, limited liability company, and limited sole proprietorship. And then both A and B. That's this last answer here. Here's the thing. You can't have a limited sole proprietorship, so that doesn't make sense. So you can't have that. If you had a limited liability partnership, that would help limit your liability. If you had an LLC, that would limit your liability. So the right answer here is D. Either the limited liability partnership or a limited liability company will help to limit individual and joint liability, as you would expect. All right. Okay, so the book here shifts gears, and they want to talk about investment income. Here's the thing. Investment income is not earned income. When we talk about earned income, that comes from an employer. And we got those four categories that show up again: salaries or wages, and then maybe also some commissions or bonuses. That's all earned income because you got that from your employer. Any other form of income is generally what we call unearned income. So maybe somebody gave you a gift. It's income, that's money that comes to you. It can be counted, but we just don't classify it as earned income because it was a gift. Same thing for investment income. That's mostly going to be considered unearned income. And for investments, you really have three categories of income that comes from investments. So maybe you have some interest that's being paid. And a lot of times that could come from a savings account. There's a couple other sources of interest. Maybe you've invested in bonds. Corporate bonds will pay you an income consisting of interest, and that's unearned income. Maybe you have some stock investments, and those stocks have done well in the year. If those companies have done well, they may declare a dividend and pay that back to the shareholders. That's another form of unearned income. Maybe that stock has appreciated in value. So you bought in and it was $50 a share, and you look and it's the end of the year, now it's $55 a share. Well, if you were to sell, you would net a $5 gain. That's a 10% gain. That's fantastic from an investment return. That's unearned income, and that's a form of capital gain. That's you invested in it, you bought something, it went up in value, and you sold it. That creates a capital gain. There's a couple other things that could show up as unearned income. Savings bonds, that's probably interest, although there could be some capital gains there as well. Maybe there's government benefits you're entitled to. Maybe you got an inheritance. Those are sources of income, but they're not considered earned income. Here we show a little bit of a cycle of how interest can work and how you can use a bank. So you deposit money in a bank. What you're really doing is you're making a loan and you're getting paid interest on that. Then that bank goes out and they loan that money to other people that they charge a higher rate of interest to than what they're paying you. So the bank's making interest on the money that you put in, and they're also paying you interest there. And that all comes from the person they lent money to, who pays the interest back to the bank. Part of that comes back to you. That's one way we explain interest income. With dividends, dividends are going to come from owning a business. And it could be a business that you own that you pay a dividend to yourself as a stockholder. That could be. But more commonly, you own somebody else's stock. And their stock has done well throughout the year. And at the end of the year, the board of directors declares a dividend. And then that money comes back to the shareholders in the form of income. That's where dividends come from. And on this slide, we're talking about, okay, well, how can you get income? Well, all right, you can work, and that's where most people's income is going to come from, is through work, through employment. If you lend money, usually by making a deposit in a bank, but also if you've bought corporate bonds, you're lending money when you do that, then you're getting interest. And then a third way to get income is as an investor. You own a piece of business. This is what happens when you buy a stock. You literally own a share of that company, and if they earn money, then a share of that comes back to you. And it can come in the form of dividends. That's part of where investment income happens, is through dividends. Another form is through capital gains. We'll get there. I'm not sure exactly why they decided to talk about objective and subjective risk at this particular point. There are risks that you take that are particular to investing. Sometimes you can measure them. When you can measure them, it's objective. If you can't measure it, it's subjective. So it's a little bit harder to frame this up in the context of where we're going here, but that's the key. If it's objective, it can be measured. If it's subjective, that means it can't. Here we've got a little bit of a diagram of what an individual's net worth looks like over a lifetime. When you start working, at age 20, you don't really have a whole lot. Most people wouldn't. And it starts to grow over time, but it really doesn't get large until age 60 or 70. At that point, you're done working. And at that point, your net worth has probably peaked. Then after you retire, you're drawing off those assets, and so your net worth is going to start to decrease. And if you time it perfectly, if you live exactly to 100 and you wanted to use all of your net worth to support that retirement, I suppose then at age 100 you'd be back down to zero. That's just a diagram showing how that's likely to play out. Ooh, this is a good question because there's a similar one that comes up on the end of the chapter exam. So someone who takes risks with his or her money by buying assets or shares in a company in hopes of getting dividends, we call that person's called an investor. And that's key here. So when you invest, you own assets in a business. And that's the key point to remember there. We talk about the idea that if you hold this investment forever, then your income will be generated by the dividends that business declares. But there's another place, if you're willing to sell that investment, and if you sell it for more than what you paid, then you have what we call a capital gain. So most of the time when we talk about capital gains, we're talking about stocks being sold. That's the most common, but there's other places where capital gains show up. Like, for example, on the bottom here, this very last piece, real estate that you own. So if you bought a house and you sold it for more than what you paid, that would be a capital gain. So your home is a capital asset. Most of the time when we talk about capital gains, we're talking about stocks and bonds and mutual funds, and the gain part comes in if you sell for more than what you paid. What you pay for a capital asset is called your basis. So if you buy a stock for $50, $50 is your basis. And yeah, if you sell it later on for more than what you paid, you got a capital gain. If you sell it for less than what you paid, you've got a capital loss. If you sell it for exactly what you paid, then you're breaking even. So calculating capital gains isn't difficult. The idea here is, what did you pay for it, right? So here they're talking about here they're using an example of a condominium. So they say you bought a condo for $70,000 to live in while you attended school. And let's say when you graduate, you sell it to somebody else for $77,000. When you sell a house, there's going to be transaction costs. And so there's some costs associated with the selling that they've listed out here. And so if you want to figure out, well, how did you do? Well, we have to look at how much did you pay for it, how much did you sell it for, and what were the additional transaction costs here, and what's left over. All right, so if you factor in that you've received $77,000 for the sale, you bought it for $70,000, so that's a profit of $7,000. If there were $4,620 in selling costs, then your net gain here for capital gain is $2,380. And those numbers have to be given to you. It's just normal that when you sell a house, there's fees that you have to pay. Realtors commission being the biggest one, but there's going to be other fees that you might have to pay as well. So if you want to say, all right, well, how good of an investment was that? Well, one way to do that is to look at what was the gain and compare it to what you paid. So if you gained $2,380 on a $70,000 investment, that comes out to a 3.4% gain. Is that good? I think it depends on what time period we're talking about. In a year, that's probably not so bad. But if it took you 10 years to tie up that kind of money to earn 3%, my guess is that you probably had better alternatives elsewhere. You don't know. There's value in owning your home that can't really be quantified here. But if you're just looking at that as a financial transaction, that's one way to measure it. So calculating capital gains is something that shows up on your end of the chapter. Example. Here's a more traditional discussion of capital gain. So here you've got somebody bought 100 shares of stock for $10 a share. He earned throughout the year, he earned $1 in dividends for each share, and then he sold all of his shares for $12. So what's his capital gain in percentage terms? Well, this one's actually fairly straightforward and easy. We can do this one in our head if we want, right? So he earned from the sale, he paid 10 and he sold it for 12. So he earned $2 on the sale and he earned a $1 dividend. He made $3 per share. He paid $10 per share. So if you're comparing what he made to what he paid, he made $3, 2 from the sale, 1 from the dividend. That's $3. on a $10 investment, that's 30%. You can do that in your head. Yeah, if you want to multiply it out by 100, which you'd have to do if you were trying to get dollars. How many dollars did he make? Well, he made $3 a share. He's got 100 shares. That's $300. That's not what this question asks. They're just looking for percentage. If you made $3 on a $10 investment, that's a 30% gain. Wanted to talk really quickly about another source of income that's a little bit more restricted. Not everybody qualifies for government benefits. Some of these benefits you qualify for by virtue of entitlement. In other words, the law says you're entitled to these benefits. The other benefits that are listed in here are welfare benefits, where you have to qualify on the basis of what you have. And we say, well, you don't have very much, and that's why we're going to provide you government assistance. So Medicaid and SNAP and TANF, those are means-tested programs. Unemployment is not a means-tested program. In other words, it doesn't matter what you have for other assets. You could still qualify for unemployment benefits. But the book wants to classify these transfers this way. So we can look at that. Unemployment is limited to people who lose their job through no fault of their own. And that's important. If you get fired for losing your job, okay, let me say that again. Sorry. Unemployment benefits, to get those, you have to lose your job through no fault of your own. So if you get fired for cause, you can't collect unemployment benefits. If you quit your job, you don't get unemployment benefits. It's only if you're laid off. You lost your job and it wasn't your fault. Here's the thing about unemployment. Number one, they don't replace a whole lot of your income. It's normally about between a third to a half. So if you qualify for unemployment benefits because you lost your job, you'll get some help. But typically they're only going to replace somewhere between a third to a half of what you were making. And then on top of that, the benefits typically only last for 26 weeks maximum. So there's kind of an incentive built into the system to make sure that you can get reconnected with the labor force, because the replacement benefits, sure, it's better than having nothing, but it isn't going to lead to a comfortable lifestyle. The other thing we see is that there's a maximum on unemployment benefits as well. When we talk about Medicaid and Medicare, Medicaid is for low-income households. Medicare is mostly for people over 65. There's a couple other groups that are allowed to buy into Medicare, but most of the time you're looking at over 65 for that. So if somebody has lost their job, unemployment benefits and Medicaid is probably a pairing they're going to be looking at. If somebody's older, Social Security benefits and Medicare work well together. When we talk about SNAP, a lot of times people just call that food stamps. That's food assistance in buying food. So that's one source of income that some people qualify for. Another one is TANF, which is Temporary Assistance for Needy Families, and that provides some supplemental income to low-income unemployed households. And typically you have to have children to qualify. So there's an application process for these, and there's a means test that's put into place. Not everybody is eligible. Most people are not. It's income-based, and it's asset-tested as well. So if you have too much in the way of assets, or if you earn too high of an income, you're not eligible for either of these programs. The last category of possible government assistance programs is called grants. And one place where grants might be something that you've seen is in assistance for education. We've got a Pell Grant program, and that provides financial aid for low-income undergraduate students. You have to show that you're low income. Your family's expected family contribution has to be relatively low. And then we look at things like what is the institution's estimated cost, whether you're full-time or part-time, and those things impact the eligibility for federal grants. But that's another form of income that you might look at. Another program that you're probably paying into right now, at least if you have a job where you have withholding taking out of your paycheck, is Social Security. And the way Social Security works, we've really got three benefit programs that are encapsulated within Social Security. You've got the old age benefit, the retirement benefit. That's the one everybody knows about. You pay taxes through your whole working career, and then when you retire, you're eligible for benefit payments. And those two things are linked. The more you pay in employment taxes, the higher the benefit that you receive. And that's something that makes Social Security pretty popular. So that's the big benefit that everybody knows about with Social Security. But there's two other benefits that are in the program that maybe people wouldn't know about. One is disability. Should you become disabled and unable to work, that is a possibility to get some help from Social Security there. We also have a survivor benefit. If we have a covered Social Security worker who dies, who has dependents, spouse and children, the spouse and children are eligible for some payments there through Social Security as well. So most of the time people know about the retirement benefit. They don't always know about the disability and the survivor benefits that are built into Social Security. The way the program works is the taxes that you pay right now are funding people who are pulling benefits right now, mostly retirees. And those contributions come not only from you as an employee, you're paying a 6.2% Social Security tax. You should be able to back that out on your paycheck. Your employer has to match that. And you may not have known that because that's not something you see. So you're paying 6.2%. Your employer has to match that with a 6.2% payment. If you are self-employed, guess what? You got to pay both halves for the employer and the employee. So you're paying the full 12.4% of your earnings yourself. Again, the money that you send in is going directly to the folks who are currently retired. It's not saved for you. Your retirement benefits will depend on the people who are working when it's time for you to retire. And that's where your benefits will come from. That is creating a problem because right now we've got 3 workers for every Social Security recipient. By the time your generation is eligible to retire, it's looking like we're going to be closer to 2 to 1. People are living longer, they're having fewer children. Those are the 2 things that are combining to create that trend. And that's what's creating our Social Security actuarial deficit. You've probably heard people say, hey, I don't know if you can rely on Social Security to be there in the future. That's maybe not entirely fair. The latest projections are that we aren't going to be able to make the benefit payments that have been promised, but the funding from folks who are going to be working in the future by the time you retire, it looks like it'll be sufficient to fund about 70% of promised benefits, which is a lot more than 0. I understand from a financial planning perspective, it's probably wisest to focus more on your own personal savings for providing for retirement and to focus less on relying on Social Security. I don't think that's a bad strategy. I just don't know that it's necessarily fair to tell people that Social Security will be gone. I think that's an overreaction to a problem that's serious. I don't mean to understate the problem, but I think we have to be honest about that. And the projections right now are making it look like we should be able to support about 70% of what's been promised. Still a problem. So this is a discussion question that comes up. How are the benefits funded and paid? What it is right now is C here. Taxes from current workers are used to fund payments to current retirees. So that's what we're looking at in terms of how Social Security works. And again, you should be seeing this on your paycheck. You're seeing a deduction. That money is not saved for you. It's not going to you. That money is currently supporting other people. And when you reach retirement age, the workers of that generation will be supporting you. It's an intergenerational compact agreement that we have. And that's been something that has served us well over the last 70, 80 years or so. Okay, so I think that's really enough to cover Chapter 3. A couple other things I just want to highlight. We didn't really talk about risk and return, although this probably came up in another place. If you want your investment returns to be big, you've got to be willing to take some risks. There's a positive relationship there. And if you want safe investments, then you're probably going to have to accept a lower return. That's something we didn't really get into when we were talking about investment income, but it is something that shows up at the end of the chapter exam, so I wanted to highlight. So, all right, I think you should be pretty well prepared if you've if you've read all the material and if you've watched this lecture. I think you should be ready for that end of the chapter exam. So best of luck to you there, and we'll see you on our next lecture.